afternoon, everyone, and happy Friday. Welcome to Stock Market Today. Allie Corman, Ed Carson here with a look at the action today and this week. And in the first week of 2022, it was quite an expectation breaker for the market rally that we were starting to see towards the end of last year, Ed.
Yeah, it sort of felt like we ran out of the gate on Monday and then just fell right on our face. So that was not a fun first week to go, but I'm going to take a look at Tesla, which is sort of typifies the expectation breaking nature of this week, but by no means was it alone. Then a couple of stocks that are looking pretty good. Hilton Hotels, Hilton Worldwide, and Cheniere Energy.
Okay, we'll do that. But first, let's take a look at the major indexes. And we'll start with a look at the Nasdaq Composite here. So we saw the Nasdaq closed down about 1% on Friday. The Russell 2000 also down over 1%. The S&P 500 down about 0.4%. The Dow roughly flat, but we have the Nasdaq now below that round number at 15,000. So not a great way to finish the week, and quite a brutal beating in the second half of the week in particular.
Yeah, obviously there was a lot of things going on, but the NASDAQ, okay, the best you can say is that it didn't undercut the December lows. That's basically it. Pretty weak there. It's actually, I think the week is closed since mid-October. So it's been a while since you ended the day this low on the NASDAQ. Just a lot of weakness and growth. It was a real expectation breaker, as you were saying at the beginning. We started off okay on Monday, and the S&P and Dow were basically at record highs. And then things started even then there was some weakness. Some of the software names were down. So there were some troubling signs, but then Tuesday it got bad. And then Wednesday it just broke open. And so, when that happens, you have to react it. You can't just say, well, it was looking good a week ago. Well, it's not looking good now. And a lot of things, a lot of the NASDAQ and the major indexes, leading stocks, not looking so good. I mean, there are obviously some areas of strength, but this was a real rough week, especially for growth investors.
Mm-hmm. And now let's take a look at the NASDAQ on a weekly chart. So now we are coming down pretty close within striking distance, Ed, of that 40-week moving average.
Yeah, pretty ugly in that regard. And I think this might be the worst week since February. I'm not sure. It would have to, it's definitely around that kind of realm. Really a sharp loss. We were just sort of at the cusp, because it looked like, oh boy, with Monday, we were on the cusp of we were going to get there, and you could just sort of sense it. Here we go, especially with other sectors going, and you saw some certain stocks doing really well, Tesla and some other positive moves, and then everything just came down. Yeah, definitely that would be, December lows, and then the 200-day line are the next things to look for.
Yes, on the downside. And also, it's just been par for the course in 2021. It seems like that's carrying over to 2022, that you have to be ready for anything and be extremely flexible in these market conditions, and new buys, be very careful with them. But no matter what you do, at the end of the day, you need to be managing that risk.
Yeah, absolutely.
And now let's also take a look at the S&P 500 coming down to its 50-day line. So ideally, we'll see some support there, but the S&P closing just under the 4,700 level. And let's also take a look at the Dow and see how it fared. So holding up a little bit better, coming down to its 21-day. That's a support level for now. Small caps, which have been struggling, getting slammed down again this week, and continuing to be one of the big themes here is that 10-year treasury yield. So seeing it at its highest levels in quite a while, passing the levels from early 2021.
Yeah, and those early 2021 levels were marked by when the NASDAQ struggled as well, because it was such a sharp rise, and you saw that, run up. And at first the market was accepting it. Then it didn't anymore. And this was an enormous gain. It was one of the biggest gains in quite a while for a week. The Fed was more hawkish. The jobs report, while some of the details were weak, there were other details that probably made people worried about inflation some more. And, you have to think that, it's up a lot for the recent stage, but really it's not that high historically. So you could see it go up a lot more. I don't know where it'll go, but this is something that look likely to drive the market for quite a while. The Fed meeting, the next Fed meeting is the end of January. That's going to be very much in focus for investors in the coming weeks.
Yeah, a pretty stunning move when you look at it and really think about it. No wonder there's a little bit of pain going on underneath the surface, and broadly, now it's showing up. It's not just weakness underneath the surface. We're seeing the major indexes, especially the Nasdaq, getting dragged down in a huge way, and growth stocks are taking the brunt of the beating. So here's the FFTY ETF, which tracks the IBD 50. Down about 8.6% this week and testing its lows from late December.
This is really weak. And aside from some of those mega caps, which are starting to really struggle now, growth stocks have really struggled for the past few months. You could argue that they've been sort of weak since February, certainly the broad market breadth. So, the underlying correction sort of there, definitely for several weeks, if not months. How much longer that can go, I don't know, but that's just something that, it's just clearly at the surface once again. And it's not been easy to outperform the indexes. It's been choppy back and forth. And then the kind of stocks that we often look at, they've not done well in the past few months.
Yeah. And so now let's take a trip around some different sector ETFs just to get a further sense of what is going on group to group. So here's a look at the IGV Tech Software ETF, hard hit this week on a weekly basis, down about 8.8% and really breaking below its recent lows. It was trying to hold on to that 40-week line, but now it seems like software is really breaking open.
Yeah, it's just broken. It's absolutely. And actually, it's worse than this looks, because this actually has stocks like Microsoft that had bad weeks, but not this bad. And the charts don't look this bad. There are some really hard hit software names. Last remaining holdouts, some stocks like Datadog just had miserable weeks. Plenty of others that have been broken all year long for the last several months, continuing to get hit. So just a lot of damage in this once really hot area.
Mm-hmm. And that's not an opportunity to start buying some of these things on sale. We need to see that strength to feel more confident and increase our odds of success, because we don't know how long this pain is going to last or where the bottom might be.
That is a really good point. I know people are always talking about wanting to get these stocks cheap. Well, yeah, you want to get them when they're working, when the trend is in your friend. There's been a lot of stocks that paused for a few days or rallied for a few days, and then they rolled over again. It's not a time to be buying. You want to see real uptrends or real strength, usually stocks near highs, not at their lows.
Mm-hmm. And elsewhere, let's take a look at XHB. So home builders, after looking so promising in recent weeks, getting hit today and really this week, down over 7%. So an area where, hey, this was starting to look like it was showing some signs of leadership, got hit as well.
Yeah, there have been some other times when the interest rates had risen somewhat in the last few months, and it held up and sometimes rose in those times. But this week, with the rates going up so much, it really came down. And even though today's move in Treasury yield was not the biggest, this was the day people just said, "Okay, I'm getting out. I'm just getting out of home builders." And there's a lot of non-home builders which may not have been hit as much. So there were some home builders that really got pummeled right now, and it's just not going to be working well with the rates rising that fast.
Yeah, half of the weekly loss just from today alone. And XLV healthcare, another area that broke out in December and now round tripping that gain under the 50-day line. So continuing to bleed here as well.
Yeah, this was really the surprise, I think, because it was doing so well in the end of the year. And then there's a variety, and a lot of stocks just sort of sold off. Yeah, there was some pieces of news late in the week, but a lot of these stocks just got hammered right off the bat and just didn't stop. And it's very broad. It was a broad rally up, and it is a broad rally down. And that's really disappointing. Really sharp loss for an area that is normally a little not quite as volatile, to be honest with you.
Yeah. And let's also take a look at XME. We're not done yet. Metals and mining held up better than most. This area did up over 1% on Friday, nearly 3% for the week. So well off of the high for the week, but still up. And so therefore heading in the right direction.
Heading in the right direction, but it would have been really hard to make money. I mean, some did, obviously, but if some of the stocks that were doing well, they reverse. You can see that Wednesday day. Well, a lot of stocks have came down either Wednesday or Thursday. And so if you're buying, this is sort of like buying in the breakout, doesn't really work too well. And it hasn't really worked with these kind of mining and stocks. And so we'll have to see, but it's that even when things go up, it's hard to make money in them, it seems.
Yeah, that's a good point there. Okay, XLF. So financials. This seems to be an area where you want to be with the rates, at least for now. So up 1.3% on Friday, but up 5.4% this week. And we were pointing out this action Monday morning, potential early entry, not only with XLF, but also FAS, the triple leveraged version of this ETF, or if you wanted to go with the regional bank flavor, KRE, also had a exceptional week this week, up 9%, but it's no doubt financials the standout area to be in.
Yeah, this was clearly the strongest area. Obviously, yields going up. If yields keep rising, these will do well. It's just always a question if that'll continue, but really nice moves and shows the importance of getting early entries because now there's some decent gains in these areas. And so if it pauses, that's okay. You can, hold on for a little while.
Mm-hmm. And with those early entries, it's why we always want to be on our toes and always try to spot the groups that are presenting those early entries. But because by the time everyone sees the breakout, well, like you said, Ed, that's where we've been seeing stocks and groups running into trouble, or the rotation it starts hitting at that time. So really being on your toes and spotting those early entries can pay off in a big way. And it seems like for those who got in this trade early in the week, may want to consider locking in some gains.
Yeah, that's part of the thing. There's definitely a different strategy. You want to just take it in your early profits. There's definitely some investors who are doing that. You can try to hang on. It depends on your investing style, but definitely don't let these gains slip away from you. If things reverse lower, look, some of these indexes, KRE and others, they can fall really hard quickly too. Mm-hmm. It's not safe as banks, and houses aren't safe as houses, at least when they're in the stock market. These things can reverse pretty quickly.
Yes. Okay. And IYT, a final area to look at. Transportation, roughly flat for the week, but it does seem like underneath the surface in the transportation group, there was a lot of tricky action.
Yeah. I mean, the trucking firms are really down sharply this week, and they were the clear leaders in that area. I'm not sure why. Maybe higher fuel costs or expectations of higher fuel costs are hitting them, because when fuel costs go up, then trains look relatively better, because trains looked pretty good. UPS looked pretty good. Shipping firms like those ocean liners, those were doing well. So it was sort of surprising to see the trucking firms come down, but transportation is still doing pretty well. You're seeing some of these Omicron sensitive areas like transportation and travel still doing pretty well. So that's a positive. But you have to be on your toes. Even when a sector is up, there's rotation even within the sectors.
Yes. And wow, that was a very comprehensive look. I definitely feel more aware of what went down this week in the different groups. We still have some stocks to check out. So why don't we do that real quick? So here's a look at Tesla. Wow, what a head fake here. It was looking so promising at the beginning of the week, but finished down almost 3%. So big downside reversal, hitting resistance at that 1200 level. But as you were saying, Ed, very indicative of what this week was like for growth investors.
Yeah, Monday looked pretty good. I mean, yeah, there was some weakness some places, but Monday was pretty good, and Tesla was a big reason why. And it broke above sort of this trend line. It was a handle on a weekly. So 11.19.10 was the buy point. Gapped up, really strong blowout delivery numbers, all sorts of reasons to be positive about it. And I don't think there was any particularly negative news after that. It just came down, and look, it's a triple digit PE stock, and those stocks have just not worked. They just haven't worked lately. And that's why this big reason why the software names have come down, and it's spread to lower PE names too. But in that scenario, it's just with the rates rising so much and you discount future growth, it just hammered them. So there's nothing against Tesla, and it didn't fall as much as some of the others, but you can have a 1 day pop on news, and then if the trend is so much against you, it may very much resume that kind of selling pressure, and that seemed to be what happened to Tesla.
Right. So definitely triggering a sell signal for recent buys there. But one area that is standing out, and that is Hilton. It broke out of a cup with handle, and this breakout hasn't failed yet. What do you think about this setup, Ed?
Yeah, I mean, yeah, I was like, yeah, you can make jokes like, yeah, you could still buy this, maybe with reservations. It's almost feels so bad saying it. I mean, there was sort of an early entry a couple of weeks ago, weeks ago, when sort of like breaking through that down slope, but the traditional buy point wasn't that far away either. That right at there, it's holding in that buy zone. Yeah, I mean, how much is it worth it to buy it? If it's going in this situation, do you want to take it with that risk that if the market melts down, probably this will come down too? I mean, this might end up being a leader. One thing I like about it, okay, yeah, 2021, obviously big rebound year, sure. I mean, nobody was staying in hotels in 2020, but next year, the earnings are supposed to be above pre-pandemic levels. And it's just like, how are they doing that? I mean, it's like, but they are in some way. So that is pretty impressive. So, I mean, so that's a positive sign, because a lot of stocks are going to see lower profits, or flat profits in 2022. So there are reasons to be positive of this. The RS line is at multi-year highs. So a lot to like about it. Definitely should be watching this and other hotel and travel stocks. It's just a matter of how much would you want to take on any risk at this point.
Right. As you said, have your reservations and keep it on the watch list for now. We'll have to keep tabs on it. And in the energy sector, that was also a place where we saw some promising action this week, including from Cheniere Energy, LNG, up 7% for the week, above average trade, clearing a trend line, did come back in a little bit on Friday, but an early entry that caught our eye.
Yeah, and you've got the early entry right there, that trend line. It sort of faltered the first time because a lot of stocks did that, but it came right back on Thursday, held above that. You could argue that maybe it's hitting resistance around the 110 area. So, I mean, you could argue, well, I could buy it now or buy it when it gets over 110, or do a little mix and match if you want. This is, it's really an LNG. So it's exporting natural gas to Asia and now increasingly to Europe. So it's a little bit different than the usual, hey, I'm going to check out crude oil prices, I'm going to check out natural gas prices. Maybe it's the gap between European natural gas prices and US natural gas prices. I'm not sure, but that should see tremendous growth this year. It's supposed to be profitable once again, really, far above normal times. So does seem to have bright prospects and not too far away from its 50-day line right now.
All right. So a couple of stocks to watch there. So with that being said, Ed, what should investors be doing now? Hopefully they're in capital preservation mode, not trying to hold and hope if stocks in their portfolio are struggling and triggering sell signals and, either eating into gains or on the losing side.
Yeah, you have to take action. Especially in some of these growth names, you probably shouldn't be in much growth at all right now, especially the highly valued ones and the unprofitable ones. And some of them have been big winners, but they are just not doing well. And those are stocks that can continue to see big losses. I mean, we've seen that with Upstart and a whole lot of other stocks that had massive gains. And then you can just see almost as equally massive losses. And it's just that kind of situation. So I need to do that. If you buy, if you're buying into energy or financials or some areas that are doing well, I'd probably be tentative at this point. Some of them have had nice runs. And if you do that, you might still want to be offsetting that by cutting other exposure, probably more, and just maybe naturally, just because you're cutting losers or cutting winners that are going back to zero, and rather than trying to build up exposure, definitely time to be defensive. But preparing for the next thing. This is just a few days in. You don't want to, you can really wreck a year in the first couple of weeks. Can't really make it too well. There's a whole lot of the 2022. Don't try to make all your money right away in a bad market. It's so much easier in a good market.
Yeah. And don't throw in the towel either. Pay attention to stocks that are setting up. Look at those RS line blue dot stocks. the different industry groups, whether it's those sector and thematic ETFs or the industry groups themselves. We have those charts available on MarketSmith too. That's what we'll be doing on Monday. So trying to uncover stocks that are resisting this downdraft and setting up and continuing to stay sharp out there, Ed.
Yeah, just a couple of points. I want to make sure it's like on growth. If you have long-term winners, that's different to be holding some core positions. So I don't want to be saying, oh, you should get out of everything that's up, you're up 1,000%. And the other thing, one reason to look at these sector ETFs or things is make sure to look at wide net. We don't know what's going to be the leading groups. And so that's why you should, when you look, let the charts tell you, and the fundamentals, the charts and the fundamentals tell you what are the leading stocks and groups, rather than saying, I'm going to be focusing on chips or I'm going to be focusing on this. Definitely be flexible, not just with the market, but with the stocks that are leaders.
Well said, Ed. Thanks so much for watching, everyone. We hope you have a great weekend, and we'll see you right back here on Monday.